What truly determines the worth of a business? Is it the power of its earnings, the stream of profits it can produce year after year? Or is it the solidity of its assets, the tangible foundation of factories, cash, and real things that remain even when earnings falter? It's a question as old as investing itself, and one that every serious investor must answer for themselves. Because at some point, markets will test what you believe value really is. When profits soar and the crowd cheers, we are tempted to think earnings are everything. But when the tide turns, when companies that once seemed unstoppable struggle to stay afloat, we are reminded that assets can be the final defense between survival and ruin. Benjamin Graham faced this dilemma in its purest form. He lived through both ecstasy and collapse, from the roaring bull market of the 1920s to the devastation of the Great Depression. And through those extremes, he learned something most investors never do: that the market's measure of value is fleeting, but the true measure of value must endure. He asked a deceptively simple question. If you strip away the market's emotions, its hopes and fears, what remains that can truly be counted on? Nearly a century later, the same question echoes through boardrooms, trading desks, and personal portfolios around the world. Do we build our understanding of value on earnings, which represent potential and growth, or on assets, which represent solidity and survival? Graham's answer would come not from theory, but from experience, bought with both success and failure. And it would become one of the most profound foundations of intelligent investing. In this episode, we'll travel through that story, from Graham's early experiments with balance sheets to his mature reflections on earnings power, and finally to what his philosophy teaches us about valuation in the modern market. Because in the end, understanding the tension between earnings and assets isn't just about how we value companies. It's about how we define reality in a world driven by imagination. Benjamin Graham began his career at a time when Wall Street was a theater of boundless optimism. The 1920s roared with speculation, ticker tapes fluttering like confetti, fortunes rising overnight, and investors convinced that prosperity had found a permanent home. Graham was a young analyst then, bright and ambitious, armed with a deep love for numbers and classical philosophy. He believed that reason and not emotion could guide a man safely through the chaos of markets. But as he soon discovered, even the most rational mind can be swept up by the tides of collective greed. At Neuberger, Henderson & Loeb, where he worked as a partner, Graham analyzed dozens of companies. What he saw both fascinated and disturbed him. Stock prices soared far beyond what balance sheets or income statements could justify. Investors spoke of momentum and vision, not of earnings or tangible worth. And then, in 1929, the music stopped. When the Great Depression struck, Graham's own fortune, built carefully through years of study, was cut by more than 70%. The same Wall Street that once celebrated him as a genius now watched as markets collapsed, companies failed, and blue chips turned to dust. Most men of that era turned cynical or desperate. Graham turned inward. He began asking questions not about the market, but about truth. How could so much apparent wealth vanish overnight? How could supposedly great companies fall from grace so completely? His answer was unsettling, but liberating. Investors had confused price with value. They believed in earnings projections that never materialized, in management promises that proved hollow, and in assets that, when tested, weren't worth what they seemed.
So Graham did what few others dared. He went back to the numbers. He began studying companies not for their glamour, but for their solidity. He looked for those that, even in liquidation, were worth more dead than alive. In the ashes of that crisis, he discovered something extraordinary. Some stocks were selling for less than the cash, receivables, and inventory they held, even after subtracting all debts. Here was a revelation. If you could buy a company for less than the value of its current assets alone, you didn't need the market's optimism, you only needed arithmetic. That idea became the cornerstone of Graham's early method, net current asset value, or NCCAV. He called these bargain issues, plain, unglamorous businesses trading below the value of what they owned. To Graham, they represented a principle far more powerful than any forecast. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. He had learned to weigh value not by popularity, but by substance. And in doing so, he planted the first seeds of what we now call value investing, a discipline born not from speculation, but from survival. But Graham's journey didn't end there. In time, he began to realize that assets alone couldn't explain everything. A company's worth, after all, wasn't only what it owned, but what it could earn. And that insight led him to the next evolution of his thinking, the delicate balance between earnings power and asset value. Every investor, whether they realize it or not, values businesses along two great dimensions, what they own and what they earn. For Benjamin Graham, this distinction wasn't just academic. It defined two entirely different ways of seeing the world. Let's start with assets. Assets are the tangible foundations of a business: cash, inventories, receivables, property, equipment, land. They represent what a company already has. They are the facts on the balance sheet, things that can be counted, touched, and sold if necessary. Graham liked that about them. In a world full of speculation, assets were real. Even if a company's future was uncertain, the presence of solid assets gave an investor something to fall back on, a margin of safety. Then there were earnings, the heartbeat of a business. Earnings reflected a company's ability to generate profits from its operations, to turn assets into income, and to reward its owners. Earnings, however, were not facts, they were flows. They depended on human judgment, changing conditions, and sometimes the unpredictable whims of the market. They could rise rapidly or disappear overnight. So, which mattered more? Early in his career, Graham leaned toward assets. He saw them as the investor's protection against uncertainty, a floor beneath which value should not fall. But as he matured, he began to see that earnings power was the real driver of long-term value. A business that consistently earns high returns on its assets can be worth far more than its tangible book value would suggest. Meanwhile, a company rich in assets but poor in profitability may be little more than a storage house for idle potential. Still, Graham never abandoned his caution. He understood that earnings were inherently fragile, easily overstated, easily misinterpreted. Earnings power, as he defined it, had to be proven, not promised. To him, earnings power value, or EPV, was not about growth projections or forecasts. It was about normalization. He would take a company's average earnings over a period of years, strip away the temporary highs and lows, and see what the business could earn in a normal environment. That figure, steady, sober, and realistic, became his basis for valuation. It was his way of saying, do not trust the enthusiasm of a single year. Trust the evidence of many.
In this balance between the certainty of assets and the potential of earnings, Graham found the dual nature of intrinsic value. Earnings measure a company's vitality. Assets measure its stability. And true value, Graham concluded, lives at the intersection of the two. But this understanding also raised a deeper question. How exactly should one calculate that value?
How could an investor quantify both protection and potential and express it in a disciplined, businesslike way? That challenge led Graham to develop one of the most rigorous analytical frameworks in investing history, a method that would shape generations of investors, including his most famous student, Warren Buffett. Benjamin Graham's method was built on one simple belief: an investor must think like a business owner. He often said that buying a stock was no different than buying an entire company. The same rules of prudence, analysis, and realism should apply. If a private business person wouldn't buy a local factory without examining its balance sheet, income stability, and margin of safety, why should an investor in Wall Street act any differently? To Graham, analysis was not a prediction game, it was an act of verification. He wanted to know in tangible terms what he was getting for his money. In his early years, particularly after the crash of 1929, Graham sought the most defensible approach to valuation. He created the concept of net current asset value, or NCAV, the total current assets of a company, cash, receivables, inventory, minus all liabilities. If a stock sold for less than 2/3 of that figure, Graham considered it a genuine bargain. Such companies might be struggling or ignored, but mathematically, they offered a clear advantage. The investor was paying less than what could be realized if the company were liquidated. These were his famous cigar butt investments, businesses with just 1 or 2 puffs of value left, yet available so cheaply that the risk of permanent loss was minimal. It was not glamorous investing, but it worked consistently. Over decades, portfolios built on these deeply undervalued stocks outperformed far more celebrated strategies. But Graham was not content with formulas. He knew markets evolve, and so must thinking. By the time he wrote The Intelligent Investor, Graham had moved beyond pure asset-based valuation. He saw that while assets provided safety, earnings determined growth and durability. He began to focus on what he called earnings power value, or EPV, an estimate of what a business could earn under normal conditions after smoothing out the temporary ups and downs. His approach was deliberate. 1. Take an average of several years' earnings, preferably a full business cycle. 2. Adjust for anomalies, unusually high profits or one-time losses. 3. Apply a conservative capitalization rate, reflecting the quality and stability of the business. This yielded a value based not on forecasts, but on proven earning ability. He wrote, "In the future value of every investment is uncertain. The best we can do is base our decisions on the past record and the present situation." In this, Graham introduced a kind of timeless humility into the practice of valuation. He didn't try to predict the future, he tried to prepare for it. In Graham's mature philosophy, neither assets nor earnings stood alone. Assets provided the margin of safety, the assurance that even if the business faltered, the investor had a floor beneath them. Earnings provided the economic engine, the capacity for the business to grow and sustain value. One protected the downside, the other to find the upside. It was this dual lens that made Graham's approach so enduring. When markets grew euphoric, he reminded investors that earnings can be fleeting. When pessimism reigned, he reminded them that real businesses with real earning power eventually recover.
In short, Graham's method was less a formula and more a discipline, a way of thinking straight when others could not. Nearly a century later, investors still debate the same question. Should we anchor on tangible book value or on earnings potential? But as Graham's students learned, the intelligent investor does not choose, he balances. And as we'll see, that balance has never been more relevant than it is today, in a world where tangible assets are vanishing, and yet the principles of intrinsic value remain unchanged.
Nearly 100 years have passed since Benjamin Graham first wrote about the tension between assets and earnings, yet the question feels more urgent than ever. Today's markets are filled with companies that own almost nothing tangible. The great enterprises of the digital age, software firms, social platforms, cloud providers, operate with few factories, little inventory, and minimal physical assets. Their value, we are told, lies not in what they own, but in what they know, in what they create, and in how much attention they command. For many investors, this has raised a troubling question. Can Graham's asset-based logic still apply in a world where balance sheets are light, but valuations are astronomical? Graham built his methods in an era when companies owned things, machines, warehouses, fleets, rail cars. Today, capital has dematerialized. Brands, patents, software code, customer data, and algorithms have replaced steel and smoke. Yet, as Graham would remind us, the principle remains unchanged. The investor's chief problem, and even his worst enemy, is likely to be himself. Whether the assets are tangible or intangible, the same human tendencies persist: overconfidence, speculation, and the surrender of judgment to emotion. When we see high-growth tech companies with little or no profits valued in the hundreds of billions of dollars, we're watching the same psychological drama that played out in the 1920s, a drama Graham knew all too well. He would not have dismissed these companies outright, but he would have insisted that investors separate reality from narrative. He might ask, if earnings are the engine of value, where is the consistent, demonstrated power? If assets provide safety, what do you truly have when the story fades? In the modern world where earnings can be adjusted, restated, or engineered, Graham's concept of earnings power becomes even more vital. The intelligent investor doesn't merely look at the magnitude of profits, they question the quality. Are those earnings produced through durable business operations or through accounting maneuvers and financial engineering? Are they backed by real cash flow or inflated expectations? Graham's logic cuts through the noise. Stable, proven earnings, even modest ones, are far more trustworthy than spectacular but fragile growth. It's not the size of earnings that matters most, it's their reliability. That principle explains why time and again, companies with humble valuations and strong balance sheets have quietly endured, while glamorous high flyers have fallen from grace. In Graham's day, the margin of safety was found in undervalued assets. Today, it can also be found in the quality of a business model, in recurring revenue, cost discipline, and resilient cash flow. A software company with minimal tangible assets can still embody Graham's wisdom if it demonstrates consistent profitability, prudent management, and a balance sheet that can weather hard times. The essence of his principle remains: do not pay for perfection. Do not bet on stories. Buy value that exists, not value that must be imagined. Each generation believes its markets are unique, but human nature doesn't evolve as quickly as technology. Fear and greed still drive the cycles of euphoria and despair. Graham's philosophy endures precisely because it is not dependent on any era. It speaks to the psychology of investors, their impatience in good times and their panic in bad.
He would look at today's market and smile knowingly. The tools have changed, the speed has increased, but the principles remain the same. Do not confuse movement with progress. Do not mistake popularity for value. Do not let the market's excitement rewrite arithmetic. When viewed through Graham's lens, modern investing becomes less about chasing trends and more about seeking truth. Whether in tangible assets or digital ones, the intelligent investor looks for what can endure, earnings that persist, businesses that adapt, and values that survive the test of time. And that search for permanence amid change leads naturally to the deeper philosophical lesson behind all of Graham's teachings. In the end,
Benjamin Graham's work was never just about numbers. It was about reality and the investor's relationship to it. To Graham, investing was a test of perception. The market, he said, is filled with illusions, prices that rise without reason, narratives that disguise weakness as strength, and emotions that turn speculation into conviction. He understood that valuation, whether through earnings or assets, is not only a financial exercise, but a moral one. It asks, do you have the discipline to see things as they are, not as you wish them to be? If you look closely, the preference between earnings or assets often reveals something deeper about the investor's own temperament. Those who chase earnings alone are often drawn to the future, to what might be, to visions of growth and expansion. They believe in stories, in progress, in the optimism of the next quarter. Those who rely solely on assets cling to the past, to what can be counted, weighed, and proven. But Graham understood that neither mindset was sufficient. A complete investor must honor both, the vision to see potential and the humility to demand proof. He would remind us that value is not found at the extremes, it is discovered in balance. Every financial statement is, in the end, a representation, a reflection of reality filtered through human judgment. Earnings can be inflated by optimism. Assets can be marked up or written down by fashion or fear. Graham's insight was that the intelligent investor does not take representations at face value, they interrogate them. They peel back assumptions, test durability, and ask the simplest yet hardest question of all: is it real? This pursuit of truth is what separates the investor from the speculator. The speculator seeks excitement. The investor seeks understanding. The speculator trusts prices. The investor trusts facts. To achieve satisfactory investment results, Graham wrote, is easier than most people realize. To achieve superior results is harder than it looks. The difference lies not in brilliance, but in temperament, in the willingness to be patient when others rush, to doubt when others are certain, and to act only when value is unmistakable. Graham's teachings were at their heart an argument for self-control. He believed the greatest threat to investment success was not market volatility, it was human emotion. By grounding analysis in assets and earnings, he gave investors a structure to defend against their own impulses. Numbers became not merely data points, but instruments of emotional discipline. He wanted investors to think in decades, not in days, to anchor their confidence in logic, not in hope. And that, perhaps, is why his ideas still resonate so deeply today. Because behind every valuation, every formula, every ratio, there stands a human being searching for certainty in an uncertain world. Graham's wisdom reminds us that certainty is not found in prediction, but in principle. So when we ask, what really matters in valuation, earnings or assets? The answer in Graham's philosophy is not a number, it is a mindset.
A commitment to seek truth over excitement, reason over emotion, and substance over story. To value what endures and to protect against what deceives. For that is the true measure of reality, not the one shouted by markets, but the one quietly confirmed by time. When we distill all of Graham's wisdom, his formulas, his teachings, his decades of experience, what remains is not complexity, but clarity. He taught that the intelligent investor does not need to predict the future to succeed. They need only to understand value, to act with discipline, and to insist on a margin of safety between what they pay and what they get. So what can we take from his question? Earnings versus assets. What really matters in valuation? 1. Start with reality, not hope.
always begin with what you can verify. Whether it's earnings, assets, or cash flow, look for what is demonstrable. Numbers grounded in history tell you more than promises rooted in forecasts. As Graham showed, the surest way to lose money is to mistake imagination for evidence. 2. Demand a margin of safety. Even the soundest analysis can be wrong. That's why Graham insisted that every investment contain a margin of safety, a buffer against error, emotion, and uncertainty. In his early years, that safety came from buying below tangible asset value. In his later years, it came from paying a fair or modest price for reliable earnings power. In our time, it might mean avoiding inflated valuations and demanding proof before faith. The form may change, but the spirit is eternal. Never risk permanent loss. 3. Value both strength and productivity. Assets give a company strength, the capacity to endure. Earnings give it productivity, the capacity to grow. A wise investor respects both. One without the other is incomplete. True intrinsic value emerges only when stability and performance align.
4. Think like an owner, not a speculator. When you buy a stock, you buy a piece of a business, not a ticket in a game of chance. Ask yourself the questions Graham would. Would I be comfortable owning this company privately? Would I still be content if the market closed for 5 years? If not, perhaps it is not an investment, but a speculation dressed in convenience. 5. Temperament over technique. In the end, your success will depend less on your intelligence and more on your temperament. Markets reward not the cleverest, but the calmest, those who can stay rational when others lose their balance. Graham often said, "The investor's chief advantage lies in their ability to remain independent of the crowd." That independence of thought, of spirit, of emotion is what turns knowledge into wisdom. When Benjamin Graham pondered the worth of a business, he wasn't merely trying to make money, he was trying to understand reality. He believed that investing, at its best, is a search for truth, not excitement, not prestige, but truth about how value endures through time. Earnings tell us what a company can achieve. Assets tell us what it can withstand. But the intelligent investor looks beyond both, toward the quiet center, where logic, humility, and discipline meet. Because what really matters in valuation is not what changes, but what lasts. Not the story that moves the market today, but the value that survives tomorrow. And in that spirit, we continue the mission of Benjamin Graham Value Insights, to preserve and share the timeless lessons of rational investing. If you found value in this reflection, consider joining our community of thoughtful investors by liking this video, subscribing to the channel, and sharing your thoughts below. Your voice helps keep Graham's wisdom alive, not as a relic of the past, but as a guide for the future. As Graham himself might remind us, to invest successfully over a lifetime does not require a stratospheric IQ or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Let's keep building that framework together.